Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, January 13th, and I'm recording this from my office in Purchase, New York. Despite the strong full-year performance, U.S. equity markets ended 2024 with a bit of a whimper. Not only did the seasonal Santa Claus rally fail to materialize, but the so-called Trump trade also evaporated, leaving the S&P 500 flat since the U.S. elections. Key to this retracement has been a surge in the 10-year Treasury yield. It has risen more than 50 basis points over the last couple of months to about 4.8%, roughly a 9-month high. For many investors, this backup in rates may seem counterintuitive, given the easing of Federal Reserve policy and consensus forecasts for economic slowing associated with the soft landing. So what is the Treasury market pricing? Decomposing the moves in rates could provide some insights. As you may know, nominal interest rates have various components, like inflation expectations, the real rate, and the term premium. And it is here that it looks like inflation expectations have actually been very stable, unchanged at about 2.3%. And that's despite concerns from many investors, including us, about how policies on tariffs and deportations could generate inflationary pressure. So with inflation expectations in check, we see that the repricing in yields has come from the other two components, the real yield and the term premium. Roughly 25 to 28 basis points of the move has come from real yields, which are a proxy for real economic growth. Similarly, 27 to 30 basis points have come from the term premium, which is the additional yield that investors expect for holding longer-term bonds. So what does this all mean? Well, first, the increase in real rates indicates above consensus expectations for growth, seemingly validating the theme of American exceptionalism. The real growth rate has been calibrated at around 2.3%, the highest since 2009, when measured on a quarterly basis. This may have implications for higher levels of the Fed policy neutral rate. In addition, and perhaps more important, is the term premium. The recent surge has taken it about 55 basis points, the highest in a decade. Remember that for much of the last 15 years, term premiums were zero or even negative, but they have returned, and policy is now starting to normalize. This represents a noteworthy change in investor demand to be paid for policy-related risks, which likely include the following: unfunded deficit spending, debt sustainability, Treasury issuance and mix, and changes to the Fed balance sheet management. These dynamics are not without investment implications. In the very short run, all this volatility may leave U.S. bonds a bit oversold and may create a buying opportunity. But for U.S. equities, the backup in rates is increasingly precarious, as it leaves relative stock bond valuations near extremes. With the 10-year yield where it is, the S&P 500 equity risk premium is sitting at negative 9 basis points. The last time stocks were this expensive relative to bonds was in 1999-2000, leading up to the tech wreck. With all this in mind, investors should consider using the Treasury sell-off as an entry point for building positions in credit and spread products. Consider also supplementing bonds with MLPs, residential REITs, select hedge fund strategies, preferreds, high dividend-paying stocks, and even emerging market debt. Be selective among highly valued growth stocks, avoiding crowded passive exposures. Thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.